To In It to Win It. This is Steve Barton, and thank you for tuning in. We are here for Monday Market Moves, talking about what happened last week in the markets and what we expect for next week. All right, the big news here is the failure of a bank and a bank run. SVB, Silicon Valley Bank, had a bank run. They closed. That bank is out of business, and a lot of people are out of luck. So what does this mean for us? And essentially what happened was there was a bank run. The bank could not cover its deposits. Everyone ran in to try to get their money or transfer it over to another bank. And when everyone did this at the same time, they didn't have enough reserves to fill the accounts. So I talked about this a few months ago in a video called "Get Your Money Out of the Bank." And basically, in a nutshell, you can click on that link and check it out. But essentially, what I'm saying is that the banks don't have any cash. And that's not necessarily what happened here with SVB, but the banks don't have any cash. So if you have any extra digits, any extra numbers on your screen when you log into your bank account, probably not a bad idea to take some of that currency out in the form of paper cash, because if we become unlucky, like the citizens of Russia or Cyprus, and there's a bank run, you'll go to the ATM to get currency out, and it won't be there. They have a lot more digits on the screen than they actually have paper cash. Silicon Valley Bank, 16th largest bank. So it's not a Wells Fargo or Bank of America or JP Morgan. And they had some very specific accounts. In other words, they were heavily invested in the tech industry. So when you go and deposit money into a bank, they can use this to invest however they want. They used to have reserve requirements. They don't anymore since 08. So what they'll do is they can immediately take your money and they can go and put it in the form of a T-bill or a bond and start making interest off of it. They can put it in cryptocurrency. They can put it in whatever they want, right? Well, what happened was with this bank is they bought a bunch of bonds a while ago when the value was high and the interest rate was low. And then now over the last year or so, we know that the value has gone down. In other words, the dollar amount's gone down and the interest rate has gone up. So when everyone went to this bank to withdraw their funds, the dollar amount in there had gone from here to here and the yield had gone up, but they got to keep the juice running. And as long as everyone doesn't go in and withdraw at the same time, no problem. But when everyone goes in to withdraw at the same time, now you're going to have a bad time. Okay. The guys that go in first get their money. The ones that are left, take their time, they're left holding the bag, and that bag is full of air, not money. So what was interesting about this was the FDIC ran in really quick. This might have been a ludicrous speed as far as them going in and taking over this bank. When they go in and they cover $250,000 per account, but most of these accounts were startup companies in the tech industry, and so they had far more than 250,000. And after 250K, you're just SOL. So they covered 250K per account, and that was it. That was it. So not too many retail was into the bank, but there was a lot of startup funds. So where are those employees now? Where are those companies? What happens to their employees? Do they get paid? Do they even have a job? What happens to that startup? Does it go under? I don't know. We will see. This kind of brings home a point in that if you have savings in a bank, let's say you're a high net worth investor, your savings exceeds 250,000, might not be a bad idea to put that into a brokerage account, something like Fidelity, Vanguard, Schwab, and make sure that it's SIPC, Securities Investor Protection Corporation, because they insure up to $500,000. So you've got 500,000 instead of 250, and 100K of that can be cash. The other 400 equities. So food for thought. What is interesting about this is the FDIC has seen this coming. And I'm going to share my screen here and share sound, and then you guys can actually see what the last meeting is that they had. This meeting was extremely hard to find. They don't make it easy. So I'll put the link in the show notes. It's 3.5 hours long. If you want to listen to it, it'll be there. If you do, I did. And I want to pick out for you guys the most interesting parts. Okay, so we're going to start here, and basically this lady's talking about a problem that they see with cash. All right, and also what day to close the banks, what day of the week. We'll pause here for a moment and see if you can guess what day that would be. All right, here we go.
How would we use targeted guarantees to allay concerns about excess cash use? There's a lot of questions here. And so, there are a lot.
Okay, so excess cash use, right? God forbid you go to the bank and actually want to pull out some cash, right? Yeah, what a terrible idea.
The things we've been thinking about, and what we want to hear from you today is what you think the priorities would be in order to go about setting expectations appropriately in public about how we would execute Title II, so that if and when we do have to have that announcement on Friday night, ideally Friday night.
Friday night. Interesting. When did the SVB announce that it's going under? Friday. Why would you do it on Friday? Well, let's see. Are banks open Saturday and Sunday? No, they're not. That way, everyone could go home and lose complete sleep over the weekend, wondering if their money's there or not.
That people are in a position to receive it, understand it, and say, yeah, that works. And we can see how this will happen. Of course, there will be doubters, but there's a lot of things going on. So with that.
First of all, I'd like to praise the FDIC for its unrelenting pressures to have more disclosure under the actual public reports. I think they have been very helpful. Second, I guess I am a bit pessimistic about your ability to communicate with the people who really need to know in terms of a crisis.
Well,
and this is partly from my experience of teaching this stuff. There was a lot of interest just after the crisis. It's dwindled over time. And so people are sort of less and less interested in getting into the nitty gritty and some of the really interesting developments. So I would think your strategy ought to be to disclose as much as possible to people who professionally need to know about it. And that would certainly include the ratings agencies and the people within the banks who are responsible for these judgments.
So the people that need to know, all right, they're not making this interview easy to find. Do you think average everyday people are in the know? No, he just said the banks need to know.
And simply have publicly available a place where people can go if they need to know more. Because we're dealing with a society where people are getting their information in tweets. There's just no patience, I think, for going through the elaborate and careful planning that has gone on. It should be there. It should be accessible when people need to know. But I don't think you have much hope of reaching a public that doesn't have a professional need to know.
Yeah.
I completely agree with that. I almost think you'd scare the public.
Yeah.
If you put this out, like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim. Right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do.
In the banking system than people in this room do, and they're laughing, right? Okay, so that tells you right there. This is the FDIC in the room, basically planning what the hell they're going to do when this crisis comes. You notice how they kept saying if and when? Okay, it's coming. So the way we can protect ourselves is, of course, have a little bit of physical gold and silver, and also take a little bit of paper cash out of the bank. You take a risk either way. You obviously have a risk. You just saw it from the FDIC themselves of keeping your money in the bank. And you also take a risk by taking it out of there. I mean, you put it in a shoebox under your bed and you could get robbed. So your risk is above zero of getting robbed in either one. But I think it's better to kind of balance the equation a little bit, have different banks, have some in one bank, some in another, have some in a brokerage account over here, have some in paper cash, have some in gold and silver. Take your pick. They're all a risk. But I think that we've kind of just grown up in this environment that there is no risk having your money in a bank. And that is certainly not true. They're not paying you interest on it. So what's the point of keeping it in there as opposed to out? Last I checked, the interest rate was 0.03% on the average savings account. Like it's nothing. Okay. So anyhow, that's that. Now let's go to the charts and see what we see for next week and how this had affected the markets. All right. So here for the S&P 500, this is really interesting because Fed Chair Powell came out and he said he said that basically they're planning on hiking 50 basis points instead of 25 in not so many words. But remember, Nick Timiraos, the Fed mouthpiece, forecast this a couple of weeks ago. Looks like he's going to be right because now if we go to the CME tool, where you can see what the market is forecasting for the Fed to do as far as interest rates, it was 72 last week when we brought it up. It was 72% for a 25 basis point hike on March 22nd, and it was 28% for a 50 basis point hike. Right after that speech, it reversed. Now it's about 68, 70% for a 50 basis point hike, and the rest for a 25. Pretty cool, huh? So it looks like they'll be increasing interest rates by 50 basis points at the time of this recording, which is Saturday. And here's how the market reacted to that. It just shot right down. And then Friday, when the bank run happened and Silicon Valley Bank closed, we got another downward spiral here, about 1.5% in the S&P 500. So we blew right past this 200-day moving average. We blew past this trend line that we've had drawn for months now. And now we're way below that in no man's land. Next resistance down here would be like 37.90. We closed the week at 38.61. There's nothing to say that this can't go back up and the little bear market rally could continue. But my bet is that on Monday, the average Joe and person who's going to read about this bank, depending on what happens tomorrow, Sunday, I think there's going to be some selling on Monday, but we'll have a much better idea of what's going on with the market. And if this bank run is the first domino to fall, I feel really sorry for people in the tech industry. This was a big bank in that sector, and that is going to drastically affect the tech sector. We got out of tech a while ago, but there's a lot of people that are still in there, and that's their livelihood, and that's sad. But anyhow, that's the S&P 500. As far as other bets that, we certainly didn't bet on that, but bets that we placed last week were on copper. We've put 3 limit orders in on COPX after having Peter Granich on the show. We realized we're probably drastically underinvested in copper. So we got COPX. It was just on a downward slope all week. 1 limit order hit for 36.50. We have 2 more limit orders in, one at 35 and another one at 34. And I'm going to close these out and basically nix those just because of what happened on Friday to make sure that they don't get filled on Monday. Because if this really is a minor liquidation crisis, it's probably going to blow right through those. And we could have got it for a lot cheaper as long as those limit orders weren't in. Another one we placed was COPJ. This is the Sprott Junior Copper Miners ETF. This just opened recently. It's only like a month or so old. this ETF. But we got one bet in, high 18s, closed the week at 1772. This does not work as a technical graph because there's absolutely no time. But what you can do is you can go to their website and you can see what it's trading as far as a discount to NAV. How do I exit this? There we go.
That
Oops.
we want them to have full faith and confidence in the banking
Sorry,
system.
this is totally unprofessional. Okay, there we go. All right, so you can see that the net asset value of all these companies combined is $18.50 per share. Right now it's trading at 1771, so you're getting a discount of 4.27%. So you can't really use the technical analysis on these brand new ones because there's nothing to go on. You have no moving averages. You have no baseline or anything. I simply use this software as a place to show me where my entry and exit points are. All right, so back to the graphs. Okay, so COPX or COPJ got an order in there. Probably going to place another one next week. We'll see. Also placed an order on GROY. That's a gold royalty corporation. So in our model portfolio, we got Franco-Nevada, we have Wheaton Precious Metals, we have Royal Gold, and now we're adding the fourth gold royalty company, Gold Royalty Corporation. All right. Had David Garofalo on the show a couple days ago. His episode will come out beginning of next week. And this is basically kind of getting in on one of these starter Franco-Nevada, starter Wheaton Precious Metals, hopefully, fingers crossed. All right. So we'll see if as time goes on, whether Gold Royalty Corporation irons out or not. But I can tell you from a technical trader, when it starts getting like this, like a flat line, you're probably pretty close to the bottom. Okay, so we got two bets in on that. One right there, and then another one just right above $2. I think it was $2.05, maybe $2.04. So at current share price, this is about a 2% dividend. Okay. TLT, the long-term 20-year treasury. This looks like it's ironing out quite well. Kind of wishing I would have had a limit order in here for around $91 because it would have hit. And then this is what you can see what happened right after the banking crisis was announced. It just shot up from one day to the next, and a big move. So pretty cool. Glad we got those bets in. They seem to be paying off. We'll see how all this unfolds. And let's go to gold. This was an interesting reaction. So we can remember that the S&P 500 dropped about 1.5%. Gold went up 2% in one day. So I think we're starting to see a bit of a decoupling here, right? The stock market's going down, gold is going up. As people become concerned about the purchasing power of the currency, they're going to move into things like precious metals. And this is a perfect example of that. So take a look at this. Gold went up, S&P 500 went down. Lo and behold, it's actually working. Okay, now let's go to silver. Silver, still like a physical bet here. I mean, when you go back over this uptrend channel right here, this is the fourth time it's hitting right now. It's under the 200-day moving average, and we got a price under $21. It hit right along this line for most of the week, right around $20. We do have downside risks down here. I don't see it getting much lower than $18. But if you're going to make a physical bet, I even wrote it on the graph here, still a great price. You know, I see this going to probably $30 by the end of the year. So who knows what the miners will do in that environment. But like a physical bet here a lot. Also like adding positions on this best buy trend line right here. Another one, SILJ. Didn't place a bet on this last week, but I still think it's a great bet right now. I mean, look at this double bottom right here. It's just hitting right at the point that we bought it a week and a half before. Like a bet there. Silvercrest is looking pretty good. We got a 1, 2, 3 hits right there. It's going up a little bit. Like it a lot. Uranium. Okay, URA is finally below $20 now. Hitting right, got a lot of resistance right down here around 1950. And then even more on this trend line around 1750. We got a little triple bottom right there that if we're lucky, it might hit it and we can get some more. URNM, this one I like even better. I did I put a limit order in? No, I didn't. And if I had, I would take it off just because we don't know what's going on with the bank. But coming along, a lot of resistance here. There's a lot of resistance built up around $30, 31. So decent buy point. We'll see how things iron out around Tuesday or Wednesday next week. But yeah, this is coming across, I think, is a possibly a pretty good buy point. That's about it as far as what I see for the charts. I think we really just got to watch what's going to happen. It'll be very interesting what happens on Monday. I anticipate the market's going to keep going down. I think there's going to be a little bit more repercussions from this. Tech industry, I think it's going to get hit pretty hard again. And we'll see if gold and silver continues its trend up over the next couple of days. Thank you guys for watching. Please hit the like and subscribe. It really helps out the channel. And leave a comment below. Tell me what you think. All right. You guys have a great rest of the day, and I will talk to you next time.